Monday, March 2, 2026. In just 24 hours, Asian markets will open, and according to Jorge Leon at Rystad Energy, speaking with Yahoo Finance this morning, oil prices could surge anywhere from $10 to $20 per barrel the moment trading resumes. To put that in context, crude closed Friday around $72.80. Tomorrow, it might spike toward $92 or more. And that's only the start. Market analysts from CNBC and Seeking Alpha are warning that investors are bracing for turbulence bigger than the Venezuela crisis. Bracing means expecting a sell-off. When risk-off sentiment hits, stocks are sold while money flees into perceived safe havens like gold and the US dollar. Gold, for instance, is already at $5,300 per ounce, up 22% in 2026 alone. Meanwhile, average retirement accounts haven't seen anything close to that growth. Informed investors saw this coming and positioned themselves ahead of the chaos. When Asian markets open, your 401k and other accounts will reflect what those investors already knew. War redistributes wealth, creating gains for some while eroding the value of your assets. The mechanism connecting missiles falling over 9,000 miles away to losses in your checking account might seem abstract, but it's direct and unavoidable. Consider last Friday. The Dow fell 1.3%, the S&P 500 down 0.4%, and Nasdaq down 1%, all before major military actions even began. By Sunday, Iran's IRGC had launched 200 missiles across 5 countries. Jordan intercepted dozens. The U.S. Fifth Fleet in Bahrain was struck, and civilians in Abu Dhabi suffered from missile debris. Friday's losses reflected anticipation. Mondays will reflect reality. And reality is always harsher. Historically, markets overreact to geopolitical shocks. Initial selling triggers momentum, which attracts more selling, and a cascade begins. The question isn't if the market drops, it's how much. Analysts predict Gulf markets could tumble 3 to 5%, and since they opened before U.S. markets, U.S. futures could gap down at Monday's open. That means your retirement account could lose value overnight without any chance to act. Let's put numbers to it. The median U.S. retirement account is $130,000. A 3% overnight drop wipes out roughly $3,900. That's money gone while you slept, with no opportunity to sell or protect yourself. Now layer on oil. Every $10 jump in crude translates to roughly 25 cents per gallon at the pump. A $20 increase, gasoline could surge 50 cents, from $3.50 to $4. For a driver using 500 gallons a year, that's an extra $2,000 spent on fuel alone. Combine that with the $3,900 retirement loss, and your household is immediately down nearly $6,000, roughly 4.5% of median income in just 24 hours. And this assumes only one day of market and oil volatility. If the conflict continues, these losses compound daily. The strain doesn't stop there. The U.S. banking system was already fragile. FDIC data shows 63 banks holding $82 billion in assets, reporting $517 billion in unrealized losses over 9 consecutive quarters. Rising oil pushes inflation. Inflation pushes interest rates, and rising rates erode bond values. Banks see capital shrink, lending tightens, businesses slow down, corporate profits drop, and stock markets decline further. Your retirement account suffers again while credit becomes harder to access. Credit card rates, already averaging nearly 24% APR, show how households get squeezed. When gasoline, groceries, and heating costs rise, families with limited credit flexibility face impossible choices: absorb the costs, cut essential spending, or go deeper into debt. Missed payments damage credit scores, which further limits access to credit, a cascade that feeds back into the financial system. Diversification, often touted as a shield, fails in these systemic crises. Normally, stocks, bonds, and international holdings move independently, protecting portfolios. But during global conflict, correlations spike. Everything falls together. A balanced 60-30-10 portfolio could see losses of 2 to 3% in a single day. Monday will show that diversification does not protect against global war. These shocks ripple beyond markets. Oil spikes quickly translate into higher diesel prices, which push grocery costs up. Transportation, utilities, and heating bills increase faster than wages. Real income declines, purchasing power erodes, and households, especially lower-income families, bear the brunt. Those who can absorb costs barely notice. Those who positioned correctly in energy stocks, gold, and bonds profit. History repeats itself. In the 1973 oil crisis, a geopolitical event in the Middle East quadrupled oil prices, spiked inflation from 3.4% to 12.3%, triggered a 16-month recession, and left unemployment peaking at 9%. Ordinary families carried the burden. Political decision-makers and investors benefited. The same pattern is unfolding today. Beyond dollars and cents, there's a psychological cost. Financial insecurity triggers anxiety, which affects decision-making, sleep, work performance, and relationships. Every market drop compounds stress, creating a cycle where real-life decisions like whether to sell or hold investments become agonizing under incomplete information. Monday morning is the first test. Your account reflects the losses, but you don't yet know how the conflict will unfold. As oil and gas prices rise through the week, discretionary spending shrinks. Families cut back on dining, entertainment, and savings to cover essentials. Lower spending depresses corporate revenues, triggering further stock declines, which feed back into your retirement account, a chain reaction of financial pressure. Even when markets stabilize, the damage lingers. Debt accumulated during the crisis through credit cards or other borrowing persists long after oil prices normalize. Compound interest on these necessary expenses can turn a short-term shock into a multi-year burden. Retirement accounts, household budgets, and future wealth growth take years to recover if they ever fully do. All of this begins Monday morning when markets open and reality updates. The losses aren't abstract. They are concrete, measurable, and directly tied to events you neither caused nor controlled. Missiles falling halfway across the world today mean fewer dollars in your account tomorrow. This is the modern global economy, tightly connected, highly financialized, and structured so that crises concentrate wealth toward those already positioned to benefit. Ordinary households bear the cost. Your bank account, your retirement, and your financial security are the front lines of conflicts you didn't start. Tomorrow, Monday morning, you'll see it. Your accounts will reflect the cost of war, the fragility of markets, and the speed at which global events translate into personal financial consequences. It's not theory, it's happening, and it starts now, in the next 24 hours when Asian markets open.